Good day, everybody. Brian here at quantlabs.net. Today is July 4th. Happy July 4th to all US viewers. Thanks for watching. Let's get into this one. This is pertaining to regulators for high-speed traders, short sellers in Asia. There's a lot of reasons why regulators do this. Specifically, I remember in 2008 time, a lot of the regulators did ban short selling when the markets were tanking. So you have to ask yourself if that's true uh, capitalist trading, or is that to preserve the financial trading system? So as it stands right now, Asia, and this is found on hedgeweek.com, high speeders, traders, short sellers facing increased scrutiny in Asia. Asian regulators risk stifling trading activity and negatively impacting market liquidity as they intensify their oversight of strategies popular among hedge funds in a bid to stabilize slumping markets. Thailand introduced increased security on HFT uh, following China's impending real-time monitoring of program trading. There's apparently I can't remember which regulator, but they want to see your code before you unleash it on the stock markets. Yeah, okay, that's really real free trading, and you cannot protect your intellectual property. Authorities expect these measures to enhance transparency. Concerns that they might reduce liquidity and make these markets less attractive overall. Just think about dark pools in the US markets, if that's fair or not. There's a balancing act here. I mean, I understand from the regulators' point of view, maybe to protect the mom and pop trader, but the mom and pop traders are getting fairly sophisticated themselves, especially when you look at the likes of like a Tradingview and what that can offer from a Tradingview perspective. It's getting fairly sophisticated as it stands. South Korea short selling ban has complicated the country's bid for an MSCI Inc. upgrade. Not so democratic and not so capitalistic in a way, but again, that's part of um, it's the same with China. And here's China. China is considered a state and control, meaning they'll let everything go fine when the markets are good, the economy is good in China, but the CCP will step in and regulate when things get bad. And in a way, U.S. is no different. The West is probably no different when things get really bad, which we can expect fairly soon with the way the markets are going. China's crackdown on quantitative trading began in February, and here's the results: stock market multi-year lows. State fund purchases providing support shares rebounded but started to fall again in May. So I can attest to that because I was trying to figure out why is the Chinese markets rising a few months ago and now it's starting to flounder again. There's your answer, because the CCP, the state of China, the central planners were buying up stock and trying to prop up the stock market, which obviously they can only do so much of that. And it's just not natural and organic in the market. So it's a form of it is manipulation. Let's put it out there. Thailand SEET dropped 8% this year, making it one of the region's poorest performers. Stock exchange will require high frequency tradings to register before placing orders as part of a broader raft of measures aimed at restoring market calm. Concerns over illegal short selling. I don't know what's defined as illegal. I mean, if you can put an order in, wouldn't that be legal? Is there manipulation? Potentially. But these markets are not liquid enough anyway. So you're going to get short selling in a highly illiquid market, which means the drawdowns are going to be much higher. So, yeah, maybe they can be manipulated. It has nothing to do with it's protecting trying to protect the markets in these countries. But there are people out there trying to short sell to take full advantage of driving down the drawdowns even further and lining their pockets. While again, mom and pop operators in those countries get killed off. So trying to regulate the program trading and corporate scandals. Well, I think corporate scandals has really nothing to do with the stock market, unless there's things I don't know, which I really don't. So let's talk about China here again. Now, this is what will happen. These restrictions could chill trading activities and harm government reputations. Let's face it, China is not exactly a clean operator. We know that. Um, and they keep Westerners out of China, the actual Chinese markets, mainland China, I'm speaking, for a reason. But they'll allow certain assets to be traded in Hong Kong or through, I think it's a China H, which I just found out that Oanda has now, along with any ETFs that are trying to be exposed to the Chinese markets, which they are not doing very well in the last few months, as this stated. So the Chinese quantitative hedge funds saw asset declines in the first quarter and first drop since 2022. So what that means, you manipulate, you make the situation worse. People will not be able to build wealth in China. Well, you know about the real estate um, uh, crash there, which was basically smoke and mirrors operation. And now the CCP are trying to basically figure out how to um, get their markets going again, because the only way citizens can build wealth now appears to be in the markets. But well, the CCP uh, preventing that from happening. And again, it comes back to South Korea. Quant fans are seeking opportunities elsewhere as the government extended the short sale ban through March 2025. So again, a lot of the liquidity is going to be found pretty well in the U.S. and the volume as well. Same with a little bit more, a little bit better, or not as much, but UK is okay as well. But anywhere else, hard to find that. So for me, I'm only focused on the U.S. markets, and anything exposed to the U.S. markets from an emerging market, if it's Brazil or Canada or Europe or wherever, that can still trade it within the U.S. markets. Again, if you want to know more about stuff like this, find out why I like my Tradingview by joining here under learnquantlabsnet.com. Thanks for watching.